Now we will do some practice questions from fixed income, module 4, fixed income markets for corporate issuers. Now coming to first question. First question, it is asking, which of the following is a benefit to a bank that makes short-term loans and issues asset-backed commercial papers? So here the bank gives short-term loans and issues asset-backed commercial papers. Why? Because by giving asset-backed commercial papers, the bank can obtain liquidity so that it can fund for short-term loans. It will further increase their loan portfolio. So hence B is the correct answer. Capital costs are reduced by providing undrawn backup liquidity instead of holding the short-term loans to maturity. Coming to second question, Ewing Corp is a large corporation that has an existing relationship with Sycamore Bank. Ewing is seeking short-term financing from committed line of credit. However, Sycamore will offer only an uncommitted line of credit. Which of the following best supports Sycamore's decision? Here, Sycamore is not willing to give committed line of credit because to issue any committed line of credit, bank requires more capital to be allocated for giving such a committed line of credit, which bank doesn't want. Hence, B is the correct answer. Now, the third question is simply a bond security buyer delivers a 50 million USD to a security seller at a rate of 0.375% for 45 days. It is just interest calculation. For 45 days, what is the interest he has to pay at the rate of 0.375% over 50 million? That is just a simple interest calculation. You will get the second option. Here the fourth question is a transaction where a hedge fund enters into a repo by taking a short position in a security with a view that its price will decline relative to the price of another security held is best described as. It is a simple reverse repo transaction. You can see from security buyer perspective, you can see it as a repo transaction. It is just a reverse repo transaction if you understand it. Now, which of the following is not a reason why issuers elect to issue long-term debt as opposed to short-term debt? So here it is asking not a reason. Now coming to first one, more stable funding for short-term debts. Okay, it is incorrect because long-term debt provides more stable funding for short-term activities. Now, more stable funding for long-term needs such as capital investments. Hence, B is incorrect. Hence, B is the answer. Lower interest rates for longer maturities for a given issuer. Actually, for longer issuers, it should be higher interest rate because we don't know what is the uncertainties involved in longer period of times. Now coming to sixth question, which of the following statements about high yield is correct? Issuers in the high yield market seek to retain financial flexibility by borrowing under leveraged loans with prepayment features or issuing bonds with contingency features.